Roku had a colossal day on Friday. They had an intraday low, or they opened on Thursday, something like that, around $60. And now they're at $95 a share. Insane, 50% move in one day. So the question becomes, is that a reasonable price to pay for Roku? Keep in mind that Roku is the third largest holding at ARK Investments by Cathie Wood. That automatically makes me think to myself, oh boy, because I don't have much respect for the Jim Cramers, the Cathie Woods of the world. I don't think they're investors. I think they're traders, and I think they're generating fees, and that's okay, except when they sit there and try to act like they're investors. So we're going to go through Roku. We're going to go through the 8 pillars. We're going to go through some fundamental ideas, the metrics. We're going to go through analyst estimates. We're going to run it through our stock analyzer tool, which will allow us to make our assumptions about the future and determine what price to pay today for Roku. Now, we're going to have basic things for the beginning investors and more advanced things for advanced investors. There's something in this video for everyone. So just make sure you watch the entire video. We have a special at the end of this video, so make sure you listen all the way through. We're going to talk about it. Let's get on with Roku and our software. Mo, you look like you want to say something to me.
So their earnings came out. They were estimated to lose $1.27 a share. They only lost 76 cents a share.
Okay.
That's pretty good.
That is pretty good.
They were estimated to make $775 billion in revenue. They did
million.
$847.2 million. Yeah.
They crushed that.
Yep.
So let's go look at some of the history of Roku. Let's look at their high level things. First off, all-time high of $490 per share back in July of 2021, and it recently in December hit a low of $38. $490 to $38, guys. That I want everybody to remember. Look at the difference. Look at this. This is literally a year and a half later. A year and a half later, and it fell over 90%. What was that, Mo?
No splits in there.
No, of course not. There's no splits in there.
Just checking.
Just went straight down.
Okay, look at this. This was COVID right here. Look at that run up that happened.
Just big absolute monster.
Everybody was worried. Run right back up, and now look at this. Now we are almost back to below COVID levels, but we are certainly below COVID here in the beginning of 2023.
Guys, stocks that are speculative and hype related like this one will have crazy volatility. You have to be ready for that one. And that's all the more reason why you need to watch this channel so you can understand the fundamentals of the business and determine if these big drops, like if you understood the valuation of Roku and you did your valuation and you said Roku is worth $490 a share, you'd be betting the farm at 38, right? As it went lower, you'd want to buy more. But when you see the parabolic rise that Mo just showed you, it's usually driven by hype, especially for a company that wasn't making money. This is a company that's valued at $13.5 billion. So what was it at its peak? The current stock price is how much, Mo?
It is
95.
95.
So it was 4 times more, at least 4 times more. So we are 50, call it 55 or $60 billion market cap. That was selling for 15 to 20 times revenue, easily back then. You have to question that. That's what we're trying to teach here. Some multiple of revenue. What multiple of revenue is reasonable? The higher the gross margin, by the way, look at this gross margin, 44.7%. That's not very high for what I would have thought. What this means is every extra unit and every extra dollar they bring in revenue, they generate about 45 cents that they can use to pay their income taxes and their overhead, okay? A company like Microsoft is 68%. That's a software business. Yeah, there's some hardware. There's obviously hardware with Roku, but it's mostly about ads and software. And no PE, no 5-year PE, no free cash flow. So this is kind of a hard company to really value because they're not generating any money. So one way to look at it is price to sales ratio. But you've got to remember, let's go look at their number of shares outstanding, and I'll explain shortly why that's important. When a company loses money hand over fist, there's 2 ways in which you can cover those losses. Issue debt, so you borrow money from people to pay those losses, or you issue equity, which means you increase shares. But the problem with that is, if you're an investor with them, the more shares they issue, the more and more they're taking away from you. They're doing what's called diluting you as an owner. And look what Roku did since 2017. They had 95 million shares outstanding. Now they have 140 million shares outstanding. They've increased the number of shares by 60, 70%. They're diluting all the investors back here. So even if the business got fundamentally better by 60 or 70%, you got nothing out of it.
Zero.
You got zero out of it because they diluted you. Now, luckily, Roku has gotten better since then. They did $430 million, and now they're doing $3.2 billion in revenue. but the losses are still mounting. They only had 1 year of profit, and that was the COVID year, basically. The year preceding June of 2021. That was all of COVID because people were stuck at home, probably watching a lot of TV, so their ad revenue was higher, et cetera. And Kathy Wood, till she's blue in the face, can say it's disruption. Guys, Roku's not disruption. How is it disruption? How many people do what Roku does? So let's go over some news and some bull and bear cases for Roku. Mo, go ahead.
So a couple of bull cases. Global streaming hours on Roku grew 21%.
Wow.
Equal to 25.1 billion total hours in Q2.
That is awesome.
That's big. The Roku channel made up 1.1% of the total US TV viewing in May.
Okay. I'm actually surprised by that.
Yeah, me too. So bear cases. The average, you're not going to like this, average revenue per user declined 7% year over year.
Oh, so guys, what that means is
they're burning through cash, obviously. It costing them $331 million, or 17% of their total cash on their balance sheet to fund the losses.
Oh boy.
And then, of course, just the move in stock prices that we've had in the last week, moving up 30+% and whatnot.
From lows to highs, it was 50% moves, even more. It's incredible.
I am super curious to see what price we get on this, but it's going to be very hard because they don't make money.
It's going to be very, very difficult. So, guys, let's go look at what our 8 pillars show. It's going to be very simple. There we go. Guys, remember, if you have our software, you can customize the pillars up to 12 different pillars. There's like 4 quadrillion different versions of it. That's more options than the lottery. Like hundreds and hundreds of times more options than the lottery. Here's our 8 pillars. Here are our 8 pillars. Revenue growth is the only one. That's a check mark. Free cash flow is decreasing. Net income is decreasing. Not negative, it's decreasing. So as they make more revenue, their losses are increasing. That's kind of bizarre, okay? No return on invested capital because they're not making money. Return shares outstanding. In the last 5 years alone, they've increased the number of shares they have by 37%. Oh boy. Let's go look at analyst estimates. Mo, analysts don't have them making money until 2027.
That's bad. Your cheerleaders don't have you making money until 2027.
So guys, when you're going to take 4 or 5 years, all these losses have to come from somewhere. Mo, let's do these losses. So we're at 8, 10, let's call it $11 before we get to cash flow positive. $11 per share with 1.4 billion shares outstanding. Is that how many? No, 140 million. Oh my gosh, I was going to cry there for a second. 140 million shares outstanding. That is $1.54 billion. It's got to come from somewhere.
And by that time, it's going to be more. It might be 1.4 billion by that time.
Yeah, shares outstanding. Yeah. Guys, that money's got to come from somewhere. It's either come from debt or issuing more shares.
And they're going to issue more shares.
And if the company market cap is 13 billion and they issue all shares for that, you're basically being diluted 10% more, assuming the stock stays at current levels. Now, obviously, if the stock goes up, it's going to cost them less shares outstanding, right?
Yeah.
Of course. Oh boy. So guys, let's look at revenue look at revenue growth. I mean, this is even amazing revenue growth.
No, it's not.
That's the funny part. Like literally, Tesla has bigger revenue growth potential than Roku.
Yeah.
At least Tesla's making money.
Right.
Wow, I'm actually surprised by this. I thought I was going to see like 20 to 30% revenue growth here. Weren't you?
And if you look at their revenue growth quarter to quarter, it's not really that great. It's really not. If you let's go back 10 quarters. 575 million, 645, 680. 865, 733, 764, 761, 867, 740, 847. It's not
like astronomical.
You would think it would be for disruption.
So if you've already gotten the impression from us, I want you to remember, we're very apprehensive about companies that lose money hand over fist. And the reason being is, 1, it's hard to value them because how do you value a money-losing business? And 2, when you sit there and look at this, everything's got to go well for this company to end up being successful. And you're going to think about the companies like Amazon and all the other Apple that back in the day when it was losing money, you're going to say, yeah, but those made it. It's selection bias. You're looking at the ones that made it. You're not remembering the 99% that did not make it or whatever percentage it is. That's what we're trying to exhibit on this channel. We're trying to tell you there is a price that is too much to pay for even the best thing in the world. So guys, let's go to our stock analyzer tool. Now, the reason this can be difficult is you've got to remember, so our stock analyzer tool is great for companies that already make money because we're going to put a profit margin in right here. And that profit margin we put in here is going to assume is going to assume that the profitability starts today. So you're already going to have a skewed number, which means to make up for that, we've got to put a really high desired annual return in here. Really, really high to account for that margin of safety and the errors along the way. This also will not factor in the immense number of shares outstanding they're going to put out there in order to pay for their losses. So guys, with our software, there's all these tools: retirement calculator, stock analyzer, analyst estimates. There are over 10,000 companies on your phone that you'll get with our software. All these tools on your phone, this community on the desktop, everything is on your phone or on the desktop. All of this available right then and there for you. Today is the last day, guys. We're running that special. The normal price is $39 a month. It's $29 a month if you sign up today, the last day of the special, July 31st. Go to everythingmoney.com and sign up. All of this available for you for under $1 per day and on your phone or computer. So go to everythingmoney.com and sign up. Mo, let's do a 10-year analysis on Roku. This is going to be so difficult, but I want you guys to listen to the things we're saying because we're going to explain to you our thought process. I mean, Mo's head is down right now going, how am I going to do this?
Yeah.
So first things first, revenue growth over the next 10 years.
So I kind of want to go 6, 12, and 18.
I love it.
And the 18 is to show how absurd it is. And the 6 is maybe low, but 12.
Keep in mind, guys, no analyst even has them growing 18% for the next 5 years.
The highest they had was...
Well, no, I mean overall.
Overall, no.
Yeah, so go to the revenue numbers. Yeah, 15.73% was the highest revenue growth. So we're doing 18% for the next 10 years.
Yeah.
It should be more in the next 5 years than the following 5 years.
Yep.
All right, now profit margin. As you guys can tell, in the last year, they did negative 20%. In the last 5 years, they averaged negative 6%. So again, we're going to start with profit margin day one. That's going to be a little bit hard because they haven't had profit margin.
What do you think we should put? Started at 8?
No, because they're going to have more loss along the way. I say we do 4,
Okay.
8,
12?
and 12. Okay.
Do you want to do the same for free cash flow margin?
Yeah.
Just because.
And guys, we do free cash flow when we're unknown or we want to see consistent free cash flow to profit margin. So most of the time, we'll put it as the same. Okay. Now, what PE should this company be selling for when it finally does make money? What price to free cash flow should it be selling for in 10 years? What we usually do is we start at 15, that's the market average, and we go higher with more growth potential and a higher return on invested capital. By the way, notice we didn't even talk about return on invested capital here.
No.
We didn't even bring it up. Why? Because there is none. We don't know what they're getting. They're not making money on their money invested in the business. Mm-hmm. So you have this question, like, how are they going to generate more and more returns as time goes on?
16, 20, and 24.
I was actually thinking 12, 18, and 24.
Oh, okay.
And the reason being is I'm doing a lower multiple because we have profit up here. And I want to make that return for the margin of safety. I just don't see this thing. If it doesn't do well, I don't see it being a high multiple business. I think people are going to crap on it very quickly. So the same thing for price to free cash flow. Now, finally, for our desired annual return, guys, remember, this is your margin of safety. As you make higher and higher assumptions, you need a higher margin of safety, so you need a higher desired return. The higher your return, the lower your price. The less you pay for something, the higher your return is going to be. If you knew you could sell this thing for $1,000, you're going to make a higher return paying $100 for it than $900 for it, right? So, desired return, factoring in this. We're starting with profitability, which doesn't exist. Mm-hmm. We're factoring in higher growth rates than existed. And 3, they're going to be diluted, and there's a lot of unknowns in a space that's pretty saturated.
I'm going to go 15, 20, and 25.
I actually like that. So guys, what we're basically saying here is
we've ever gone that high.
I need to make big money here. I need to make big money here to justify this return. Big money, because there's so many positives I put up here. The profitability day one is the hardest part.
Yes, it is.
So guys, we're going to hit the analyze button. I want you to stick around to the end of this video. And don't forget, guys, everythingmoney.com to sign up for our software. But stick around to the end of this video because we're going to explain these numbers further. It's only going to be 1 or 2 more minutes, so just hang on tight with me. All right, I got a low price of 10, a high price of 56, a middle price of 28, which means if you pay today's price of $94 and the lowest assumptions occur, you're going to lose about 12% a year. If you pay today's price, the middle assumptions occur, you make 3.8. If you pay today's price and the high assumptions occur, you're going to kill it, 17.4%. So Let's go back here and see what it says. But again, guys, remember, that's assuming profitability day one. That's assuming probably that they don't issue any more shares outstanding. It's hard. It's a very, very tough situation. So for me, maybe at $38 when it was at in the low, it might have been worth a flyer. Just put a few bucks in it and hope that it can magnify. But I don't see the disruption in this business that could really multi-bag and go much, much higher. That's my personal opinion.
Honestly, the flyer price is like, I just hope that the stock price goes to 150.
Yeah.
I don't think that the financials will justify it.
It's just going to be very difficult. So guys, everythingmoney.com, sign up, get our software. Today is the last day of $29 a month. Sign up now, less than $1 a day. Take care.